Welcome to College Accounting, Chapter 2, Analyzing Transactions into Debit and Credit Parts. The goals of Chapter 2 are to understand how to analyze transactions into debit and credit parts, identify accounting practices relating to analyzing transactions into debit and credit parts, use T accounts to analyze transactions, and then analyze transactions and how they affect the accounting equation and how they affect owner's equity. We're going to next talk about using T accounts to analyze transactions. If we think back to Chapter 1, in Chapter 1, we learned about the accounting equation. The accounting equation showed how assets have to equal liabilities plus owner's equity. And how underneath the assets there are various different accounts, as well as under liabilities and owner's equity. An account is any record summarizing all the information pertaining to a single item in the accounting equation. So if you recall from Chapter 1, we talked about the various different types of accounts under assets. For instance, cash, accounts receivable, supplies, prepaid insurance, etc. And under the liabilities, we primarily focused on accounts payable. And under the owner's equity, we talked about the owner's capital account. In this chapter, we're going to use an accounting device called the T account to help us analyze transactions. In Chapter 1, we talked about how every transaction can be analyzed into two parts. It's going to affect at least two different accounts, and that whenever a transaction took place, it always had to result in the accounting equation staying in balance. In this chapter, we're going to learn how we can use this T account to help us analyze our transactions and make sure that our accounting equation is staying in balance. First, when we look at the T account can be broken down into the larger accounting equation, assets equals liabilities plus owner's equity. And always the left side of the T account is known as the debit side. And always the right side of the T account is known as the credit side. So we say T account, left side, debit side, right side, credit side. Simple rule. As we begin to use T accounts to analyze transactions, we need to keep in mind the basic accounting equation and that each account under the accounting equation can be broken down and have its own individual T account with a debit side and a credit side. We also need to keep in mind that every type of account has what we call a normal balance. The normal balance is the side of the account that account increases on. So for instance, assets have a normal balance on what we call the debit side, whereas liabilities and owner's equity have a normal balance on the credit side. As you can see from this picture, the assets when looking at the larger accounting equation, assets equal liabilities plus owner's equity, we said the left side of the accounting equation is the debit side and the right side is the credit side. So it would make sense that when you break down each account into its own individual T account, the normal balance side would stay on the same side for that type of account. So assets have a normal balance on the debit side because they're on the left side of the accounting equation, whereas liabilities and owner's equity have a normal balance on the credit side because they are on the right side of the accounting equation. So anything that's on the left side of the accounting equation has a normal balance on the left side. On the right side of the accounting equation, liabilities and owner's equity, the capital account, have a normal balance on the right side, the credit side. So how can we use this information with regard to T accounts and normal balances and debits and credits to help us to understand how transactions affect the accounting equation? Well, first thing we need to do is go back again to Chapter 1. If you recall in Chapter 1, whenever we had a transaction, I would always ask you, how does that transaction affect that account? Is it increasing that account or decreasing that account? Okay, so we need to keep all of that information in mind as we go through and utilize this T account. First of all, looking at basic rules. Accounts increase on what we call the normal balance side. So you have to keep going back to those rules from this previous slide where the normal balance side is for each different type of account, because accounts always increase on their normal balance side. Second, accounts decrease on the side opposite their normal balance side. So the first question you ask yourself whenever you're looking at a transaction is you're going to say, what's happening to the, first of all, you're going to ask, what are the two types of accounts that are affected? Then you're going to say, what's happening to those accounts? Are they going up or are they going down? Then, once you think about whether they're going up or down, you say, which side do they increase on? If the account is going up and it's an asset type of account, assets increase on the debit side. So if an asset is increasing, it's going to be on the debit side. If an asset account was decreasing, it's going to be on the credit side of the T account. Whereas if you have a liability or the owner's capital account, those increase on the credit side because their normal balance is on the credit side. Whereas if a liability were decreasing, it's going to decrease on the debit side. And the same with the owner's capital account. The owner's capital account is going to decrease on the debit side. This is the end of section 2.1, using T accounts to analyze transactions.